Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full-service financial services firm headquartered right here in Boulder, Colorado. Recording this on the evening of Friday, December 27th. It's my year-end video, and there's still 1.5 business days left, Monday and Tuesday, but I figured we were close enough. Assuming nothing major happens on the last day and a half, we're good to go for a good conclusion for 2019, which is one of those years that we all live for. As we look back at the unmanaged stock market indexes over the last 3-4 years, we had 2015 positive, 2016 positive, 2017 positive, 2018 negative, and 2019 positive. Historically, for a 4-year presidential, kind of the year that's the election year, it has historically been positive, more than 50%. But more subdued than the other 3 years. Who knows? I mean, that's the thing is, you've got to have a long-term strategy. You don't do things month by month or year by year. As a matter of fact, I would say that the big lesson for this next year, because it is election year, is let's keep our politics out of our investments. If you are displeased with the current president, you're happy, you're saying that it's a big mandate on his policies in 2017, but then 2018 it flipped. It was sharply negative. And then 2019 it's sharply positive. I mean, I think that we give whoever is in power, our particular politicians and our president, too much credit and too much blame. And I can have that argument with you. Not today over this video. All I can really say is when you're watching news all day long, you're going to come away thinking that everything is politics, and it's just not true. There's a bigger world than that. And you're going to come away thinking that everything has an answer. You look up at the clouds in the sky, and our mind looks for patterns, makes that bear or that nice sheep up in the sky when it really isn't there. Well, journalists have a tendency to say, the reason why this happened, it went up, it went down, whatever, it was volatile, non-volatile, was because of this. Take it with a grain of salt. It's just not quite as simple as they would lead you to believe in the few minutes that they have on TV. I've got lots of charts today that I want to share with you because it is the end of the year. This is a chart I'm putting up on the screen for the last number of years, since 1996. You're going to see I did a couple of circles on the far right-hand corner. You're going to see a huge run-up going all the way up from 2009 to the present. You can see that there's, I did it in blue there. There were a couple of years where it was kind of stagnant, and then we had a big upswing again. And then you can see there in 2018, it was kind of sideways again. If you only focus on those and your whole focus, your investment strategy is to avoid the downturns, then you're never going to have the upturns, in my opinion. So you can't look at it that way. I mean, who goes into a friendship saying, well, I don't really want to have this person as a friend with all the good times because I'm worried that we might have an argument? I mean, that's ridiculous. Don't treat investments the same way. You don't go in so fearful of some of the negative things when, on balance, I would argue the positives outweigh the negatives. This next screen you're going to see is corporate profits are positive. So I just want to talk about how 2019 was an incredible year, and the corporate profits continue going forward, and with the earnings estimates as well. You're going to see that the S&P valuation level, this next chart on the far right-hand side, it's nowhere near where it was in the late 90s. I've heard a few pundits on TV talking about, is this right before a big bubble and the huge valuations after a big run up in the in the stock market? The answer is they're nowhere near, and so it's, from my point of view, it's trying to compare apples and oranges, make a story where there is no story. The next graph I'm going to throw up on there is on the right-hand side. You're going to see that bottom line there. That shows our current economic expansion and after a recession, compared to many different recessions going back 60, 70, 80 years. And what it shows is that we've had, in comparison to other recessions since 2008, a relatively mediocre recovery from an economy point of view, even though we've had a great stock market. The economy is not the stock market. That's I've made that argument in previous videos. But from an economy point of view, it has been relatively mediocre, not quite as hot as previous recoveries, but it has been longer than the other ones as well. So, maybe that's better. I mean, frankly, when we add it all up, when we have a recession in the future, we'll look at it and historians will say, wow, it was warm but much longer, twice as long. Maybe that's better than having it super hot for a shorter amount of time. Only time will tell. But that's what we have right now and have had for the last 11, 12 years or so. Right now, look at this next chart. You're going to see unemployment and wages. On the far right-hand side, we are at historically very low unemployment, which is a great thing. Just a decade ago, we were at 10% unemployment, and now we're at 2 or 3. And so this is a great thing. And over the last 7, 8 years or so, we have had wage growth increase, particularly in the last 2 or 3 years. It's just kind of the way it works out. And I definitely don't give any party and power all that credit. It just doesn't work out that way. The next chart up there I want to talk about is the interest rates and inflation. You're going to basically see that we have inflation at incredible lows right now, which is a good thing. And the last thing that I want to show before I get into a little bit of analysis is the yield curve. The reason why I want to show this yield curve to you is all summer for 2 months, all we heard about is the yield curve and how the sky is falling and how it's the most important thing in the world. And when's the last time you heard someone talk about the yield curve? It's quite frustrating from my point of view at times when I hear these pundits or when I hear people talk about the pundits, is that they're always coming up with predictions that many of them are wrong, and yet people still listen to these particular pundits. One of my colleagues said something I thought was pretty funny the other day. He says, sometimes they're right, sometimes they're wrong, but they're always certain. And that's so true. They're always so, confident in their prediction, where I believe that long-term, from an investing point of view and reaching your financial goals, you need to have some humility. Hey, I believe this is what's going to happen. There's lots of different variables in the equation, but you know what? Maybe I'm wrong. Okay, that's the point. And getting back to long-term success, it's not just 1 year. I mean, while this is my 2019 year-end review, listen, we're not investing for a year. We're investing for multiple years. I don't care if you're in your 70s or 80s. Hopefully you're not going to die in the next year. I mean, you still have to ensure that you don't outlive your money. So we have long-term strategies, and you've got to look at it that particular way as well. Here we are, talking about 1 year, but goodness, it needs to fit into a whole strategy. One of the things that I do for all my clients is a financial plan. Where are we going? How are we going to get there? What are the variables we can control, and what are the variables that we think we can control, but we really can't? Great example would be we can control how much we save. We can control when we retire. We can control on what income we retire at that point, okay? How much we want to draw out in the future, what kind of a lifestyle. Things that we don't control are when we're going to die. Okay, I mean, we think we're gonna, maybe live 15, we live 25. We think we're gonna live 25, we live 15. We don't know that. And while we try to control the rate of return, and there's so much focus on it, that is something that we don't have control over. Okay, we can try to control the band, the upper limit, the lower limit. We're gonna try to control that with various risk levels and investments and, a balanced portfolio, etc. But that's something that we just don't have control over. So I like to focus clients, and I'm going to continue this next year on focusing on what are the variables that we have control over to increase the probability that we're going to meet our particular financial goals, whatever they might be. That's it. One thing you'll notice is that I'm not giving any prediction about 2020. Okay, the one thing I'm going to give a prediction on is sometimes the market will go up and sometimes it'll go down. We're going to talk about politics all year long, and half America is going to be happy at the end of the year and half are not. That's about as close to predictions as I can give this year. I don't believe that it's in your best interest to become, I could sit here and give a falsely positive, of course it's going to go up and this is the reason why. And that might be what you want to hear, but I would be disingenuous if I did that. I could be very negative this year. But why would I want to do that? I mean, 3 out of 4 years historically have been positive. I could be negative. I could get you fearful. I could get you in defensive strategies, things of that nature. But you know what? I don't know the future any more than you do. The best thing that I can do is counsel you on how can we increase that probability. How can we set things up to take advantage of things, the favorable conditions if they're forward, watching and keeping in control of our emotions if they're not. So Mike Brady, Generosity Wealth Management, 303-747-6455. You have a wonderful day and a wonderful 2020 year. Bye-bye now.